Today is Friday, January 30th, 2026, the final trading session of the month, the closing day of this week, and silver has just plummeted from $121 down to $95. A staggering $26 evaporated in mere hours. Gold has plunged from $5,600 to $4,050, $650 erased. If you are viewing this and feeling a sense of panic right now, I urge you to pause, take a deep breath, and watch this entire presentation. Because what I am about to reveal defies all logic. The figures do not align. The narrative the market is feeding you is not the true story. Silver collapsed 22% this week, one of the most significant weekly declines in recent memory. And yet, at this precise instant, you cannot purchase physical silver. The Perth Mint in Australia has halted all sales. The United States Mint has suspended transactions. The Royal Mint in the United Kingdom is completely out of inventory. Dealers across India are failing to fulfill deliveries. Costco has enacted purchasing restrictions. Allow me to repeat that for emphasis, so the full weight of it settles in. The price is in freefall, yet you are unable to acquire the actual commodity. Does that seem rational to you? Does that resemble a functioning, legitimate marketplace? In any ordinary market, when prices crash, supply surges, sellers emerge, and product becomes readily available. That is the fundamental mechanism of markets. But that is categorically not what is occurring here. Here, the price is collapsing while physical supply is evaporating. The price is declining while the entire globe is experiencing a shortage. Something is profoundly amiss. And by the conclusion of this video, you will comprehend exactly what that is. Welcome to the Obscured Economy. If you are a new viewer here, I specialize in uncovering the true dynamics of markets, while the mainstream remains fixated on superficial headlines. Subscribe immediately, because this is the caliber of insight you will not discover elsewhere. If you perceive value in this content, please press the like button emphatically. It assists the platform's algorithm in sharing this with more individuals who require this knowledge. Now, allow me to elucidate why today's dramatic drop is not what it appears to be. Several days prior, I published a video. In that presentation, I indicated that the 117 level was a critical threshold for silver. I detailed why a severe downturn was probable. I illustrated a consistent 3-decade historical pattern. At that moment, the prevailing sentiment was overwhelmingly optimistic. Now, we have arrived at that foreseen juncture. Silver has indeed crashed from 121 to 95. However, here is what I did not anticipate. I did not foresee that concurrent with silver's price collapse, the physical marketplace would experience a total failure. I did not expect mints across the world to cease sales. I did not predict a complete and utter schism between the paper trading realm and the physical metal reality. And that is the essential discussion we must have. Let me demonstrate what is genuinely transpiring behind the curtain. Pay close attention, because grasping this distinction could prevent you from committing a monumental financial error. First, I must explain the structure of the silver market, as most individuals do not comprehend this, and that lack of understanding is eroding their wealth. There exist two distinct silver markets, not merely one. Two. And at this moment, these two markets are communicating entirely contradictory narratives. The initial market is the paper silver market. This is the COMEX. This is where futures, contracts, derivatives, and digital representations of silver are traded. This is the domain where hedge funds, banking institutions, and large-scale entities exchange billions in silver value daily. But here's the crucial understanding. They are not transacting in real silver. They are trading paper promises, contractual agreements that stipulate someone will deliver silver at a future date. The overwhelming majority of these contracts never culminate in actual metal delivery. They are merely wagers, casino chips, financial instruments frequently devoid of any backing in physical metal. The paper market resembles an immense poker game. Billions shift hands, yet when the session concludes, most participants never actually see or handle any tangible silver. The secondary market is the physical silver market. This is where actual concrete silver is traded, real metal. Coins you can grasp, bars you can stack, the material that exists in the tangible world. Now here's the pivotal point. These two markets are supposed to be linked. The paper price is intended to mirror what physical silver is authentically worth in reality. But presently, at this very second, they are wholly detached. The connection is severed. The paper market declares silver is worth 95. The physical market declares you cannot obtain any at virtually any price. One of these is deceiving you. Which do you trust? The digits on a computer monitor or the vacant shelves at the mint? Let me present the evidence. Perth Mint, Australia. Among the largest and most esteemed mints globally, they have produced gold and silver bullion for over 100 years. Governments rely on them. Institutions rely on them. Individual investors rely on them. On Thursday morning, prior to the crash even initiating, while silver was still trading near 117, they distributed a notice to their wholesale distributors. I have reviewed this notice. It states the following. Due to the increasing worldwide demand for silver bullion products, we have a large backlog of orders for the 2026 Kangaroo 10's silver bullion coin. As a result of this, we have decided to pause taking wholesale orders for this coin from today until 23rd February to clear the back orders. Examine that text once more. Allow each word to resonate. Increasing worldwide demand, not decreasing. Large backlog of orders, not a surplus of inventory. Pause taking orders, not a discount sale. A halt until February 23rd. That is nearly an entire month without accepting new wholesale orders. This communication was issued when silver was still at 117 before the crash, when surface level conditions appeared stable. They are also enacting monthly allocations to ensure all regions receive some stock. Monthly allocations. That is the language of rationing. That is the action of an entity that does not possess sufficient product to satisfy demand. This is not a corporation having an off day. This is not a transient website malfunction. This is the official mint of the Australian government, one of the most reputable globally, informing the international market that it cannot match the demand for physical silver. Australia is itself a leading silver-producing nation, and its own sovereign mint cannot secure adequate silver. Internalize that. And then the crash transpired. Silver plunged from $117 to $95, a discount exceeding $20 within days. Now, engage in logical thought, employ common sense. If the Perth Mint was already at a breaking point with silver at 117, what transpired when silver crashed to $95? Every astute investor worldwide just witnessed a 22% discount on an asset that mints cannot even maintain in stock. What action did they take? They purchased. They acquired every ounce they could locate. The crash did not diminish demand. It generated a tidal wave of fresh demand. Now observe the United States Mint. The U.S. Mint has suspended all sales of silver numismatic products. Their website lists products as temporarily unavailable. Contacting their customer service yields explanations of updating prices. But here is the actual sequence of events. Silver prices moved with such velocity that the mint could not adjust its pricing quickly enough. They were selling silver eagles at $91 while the spot price soared past $90. They were incurring a loss on every single sale. Consequently, they halted. They suspended all activity, and when products eventually reappeared online, the price had catapulted from $91 to $169, an 86% price surge overnight. The 2026 American Silver Eagle, scheduled for a January release, has been postponed to late February. Subscription offerings are already entirely sold out. This is the official government mint of the United States of America, communicating that it cannot sell you silver at previous prices and lacks sufficient inventory at the new higher prices. But the situation deteriorates further. India, and one of the planet's largest silver markets. Currently, dealers are not merely experiencing low inventory. They are defaulting on deliveries. This signifies they are accepting orders, receiving payment, and then failing to provide the product. Individuals are paying for silver and not receiving it. Headlines from India are alarming. Not even a sliver of silver available. Sellers on Amazon India are defaulting on silver deliveries. People are posting screenshots of their orders being canceled after payment was processed. This is no longer merely a supply issue. This is a failure of the physical delivery mechanism itself, and it worsens still. The Royal Mint, Great Britain. The official mint of the United Kingdom, one of the oldest mints in existence, producing coins for over a millennium. They are out of stock on silver bars. Even 1 kilogram bars, the most fundamental common format, are unavailable. When major sovereign mints across multiple continents, Perth, US, Royal, are all encountering identical issues simultaneously, that is not coincidence. That is not misfortune. That is a systemic crisis. If you believe that is severe, await the report on Rendrexo. Costco. Yes, Costco, the wholesale retail giant where one buys household supplies and prepared meals. They sell silver bullion. They have implemented purchase limits. You can no longer buy in unlimited quantities. They are restricting transaction sizes. Costco is rationing silver. Absorb that implication. A retail chain famed for bulk sales is now limiting your acquisition of silver. Why would they enact this? Because demand is utterly overwhelming supply. They must ration their remaining stock. Yet here is where the scenario becomes truly alarming. Let me reveal the developments in China. This segment should genuinely concern you. I possess data from the Shanghai Futures Exchange dated today, January 30th. Current factual numbers. The SHFE silver vaults presently contain 455 metric tons of silver. That equates to 14.6 million ounces. It may sound substantial. It is not. And here's the detail that caused my astonishment. In a single day, 26.94 metric tons were withdrawn from these vaults, nearly 27 tons in one 24-hour period, one solitary trading session. You must comprehend the extraordinary nature of this figure. 27 tons approximates to 870,000 ounces removed from a single exchange in one day. At this rate of depletion, the Shanghai vaults could be entirely emptied in under 3 weeks. For context, annual global silver demand exceeds 1 billion ounces. The Shanghai vaults now hold a mere 14.6 million ounces. That is barely 1% of yearly demand. It is negligible. It is a statistical rounding error. And no one in the mainstream financial media is discussing this. No one. Now, consider what renders this truly frightening. China has already imposed restrictions on silver exports. They have classified silver as a strategic national security asset. They are treating silver identically to rare earth minerals, identically to materials essential for weaponry and artificial intelligence infrastructure. Therefore, analyze China's actions. They are prohibiting exports. No silver departs China. Concurrently, they are draining their own exchange vaults, taking physical possession, transferring metal from public warehouses to undisclosed private storage. What does this indicate? It indicates China possesses knowledge we do not. They are aware of what approaches. They are stockpiling physical silver while the paper market crashes. They are preparing for a specific future. While American entities sell paper contracts and depress the price, China is securing physical delivery of every attainable ounce. One faction sells paper. The opposing faction hoards metal. Which faction do you presume understands silver's authentic value? Now allow me to identify the sellers. This is potentially the most vital portion of this entire presentation. Listen with utmost focus to what follows. Almost all the selling pressure this week in silver has materialized during United States market hours. Not during Asian trading when Shanghai and Hong Kong are active, not during European hours when London operates, specifically during US market hours, when New York awakens and COMEX opens. When New York commences trading, silver plunges, red candlesticks dominate. Aggressive, voluminous selling, price collapses. When New York concludes trading, silver stabilizes. Occasionally, it even climbs during Asian hours. Then, New York reopens and the selling recommences. This pattern has recurred every single day this week. It is not random, it is coordinated. The United States sells and dumps digital derivatives and paper promises. The remainder of the globe purchases and accumulates physical metal. Stop momentarily. I need you to profoundly contemplate the statement I just made. American financial institutions are selling an asset they do not physically possess. They are generating digital silver from nothing, pressing keys, shifting numbers on screens. Simultaneously, entities in Asia and the Middle East are loading physical bars onto trucks. They are accepting delivery. They are emptying vaults. They are extracting real metal from the system. One side engages in a video game simulation. The other side collects the tangible prize. American banks and institutions are inundating the paper market with sell orders, forcing the price downward. They sell contracts for silver they do not own, fabricating supply via keystrokes. Meanwhile, purchasers in China, Japan, and India are procuring genuine physical metal. Buyers in Dubai and the UAE are procuring genuine physical metal. They are taking delivery. They are depleting vaults. They are removing silver from circulation. The paper price declines. The physical metal vanishes. This pattern is not novel. It has persisted for as long as I can recall. For years. For decades. The Western financial system sells paper. The Eastern Hemisphere purchases physical. But presently, this activity is more aggressive than ever. The disconnect between paper selling and physical acquisition has never been this extreme. This is not a free market. This is a manipulated contest. And if you do not comprehend the rules of this contest, you will become its casualty. You will surrender your physical metal at the price bottom, frightened by the paper price, and an entity in Shanghai or Dubai will gratefully accept it from you. Do not be the victim. Be the individual who comprehends. Let me illustrate the lease rates. Lease rates represent the cost to borrow physical silver. In normal market conditions, these rates hover near zero, approximately 0.3% to 0.5%. Presently, silver lease rates have skyrocketed. Some reports indicate 8%, others show rates as elevated as 39%. 39% to borrow silver. That is a signal of panic. That signifies physical silver is so scarce that its holders demand exorbitant premiums merely to lend it temporarily. When lease rates spike to this degree, it indicates the physical market is fractured. It signifies insufficient real metal exists to satisfy requirements. Now let me synthesize all of this for you. What we are observing is the total failure of the paper-silver pricing mechanism. For decades, the price of silver has been established by paper trading. Banks exchange hundreds of millions of ounces of paper silver daily. The genuine physical market is minuscule by comparison. This has permitted the paper price to be manipulated, suppressed, and controlled. But now a fundamental shift has occurred. Physical demand has overwhelmed the system. Mints cannot maintain pace. Vaults are being emptied. Dealers are defaulting. Lease rates are exploding. The paper market proclaims $95. The physical market proclaims no silver is available at any cost. Ultimately, one of these must yield. Either the paper price ascends to reflect physical reality, or the physical market undergoes a complete collapse. I posit we are nearing that breaking point. Now let me clarify what this signifies for you, because understanding the scenario is futile without knowing how to respond. I will be unequivocally direct, no softening of terms. If you possess physical silver, do not panic. I reiterate, do not panic. Do not permit the paper price to frighten you into liquidating your metal. Scrutinize the facts. Mints are suspending sales. Dealers are defaulting. China is stockpiling. Vaults are draining. Lease rates are exploding. And you are positioned holding the singular asset for which the entire world is desperately searching. The paper price is mere noise. It is manipulation. Your physical metal is worth what someone will genuinely pay for it in the real world. Currently, that value is significantly above 95. Retain your metal. Do not be deceived. If you hold paper silver, ETFs, futures contracts, pose yourself one critical inquiry. If every participant demanded physical delivery tomorrow, could your counterparty actually deliver? The answer is likely negative. There is insufficient metal. You do not own silver. You own a promise, and promises can be broken. If you are seeking to purchase, I wish you success. Physical premiums are skyrocketing. Japan is paying 60% above the spot price. Dubai is paying 40% above spot. The paper price states 95. The real world price is 120, 130, or higher. If you can locate physical silver at relatively reasonable premiums, consider yourself fortunate. That inventory will not persist. And here is the paradox that will challenge your perception. The lower the paper price crashes, the more rapidly physical silver disappears. Lower prices stimulate greater demand. Increased demand depletes supply more swiftly. The crash is exacerbating the shortage, not alleviating it. Now let me address a significant counterpoint. Some individuals will dismiss this as conspiracy theory. They will assert the silver market is operating normally. They will claim mints are experiencing temporary difficulties. To those individuals, I respond, examine the evidence. Perth Mint, suspended. US Mint, suspended and repriced 86% higher. Royal Mint, UK, out of stock. India, defaulting on deliveries. Costco, purchase limits. Shanghai, 27 tons drained in one day. Lease rates, 39%. This is not one mint enduring a difficult week. This is every major global source of physical silver undergoing unprecedented strain concurrently. That is not conspiracy. That is data. That is factual information. That is reality. Now let us discuss timing. Today is Friday, the final trading day of January, the concluding day of the week. This is not accidental. Substantial market moves frequently occur on Fridays, particularly month-end Fridays. Options expire, futures contracts settle, traders adjust their portfolios. The timing of this crash was not random, it was calculated. January represented silver's most impressive month in decades, 65% gains, record-breaking advances. Now, on the absolute final day of January, they crash it. They dispatch a message. They shake out insecure investors. They generate fear. This is the methodology of the game. This is how wealth is transferred from emotional retail traders to patient institutional accumulators. Your fear fabricates their purchasing opportunity. Let me reveal the broader perspective, because today's events did not originate today. This has been developing for years. Silver has been in a documented supply deficit for 5 consecutive years. 5 years. Since 2021, annual demand has surpassed annual supply every single year. Permit me to elaborate. Annually, global mining yields approximately 835 million ounces of silver. That is total worldwide mine production. Yet annually, global consumption exceeds 1 billion ounces. This encompasses industrial demand for solar panels, electronics, electric vehicles, medical devices, and myriad other applications. It includes investment demand for coins, bars, and ETFs. It includes jewelry and silverware demand. Aggregate demand outstrips total mine supply by hundreds of millions of ounces each year. The cumulative deficit across these 5 years exceeds 800 million ounces. 800 million ounces wherein demand has overwhelmed supply. From where does this additional silver originate? It is sourced from above-ground stockpiles, vaults, historical reserves, recycled materials, inventory accumulated over prior decades. Conceptualize it as a bathtub. New mine supply is the water flowing from the faucet. Demand is the water draining through the outlet. For 5 years, more water has drained than entered. The bathtub is emptying. Those stockpiles are now perilously low. The buffer is nearly exhausted. Shanghai vaults are at critical lows. COMEX registered silver has been diminishing for years. London vaults have witnessed significant withdrawals as metal flows toward India and Asia. The cushion is gone. The reserve is depleted. No additional slack remains within the system. No emergency stockpile exists to utilize during demand surges. And now, with mints suspending sales and dealers defaulting, we are witnessing the consequences of years of persistent deficits finally manifesting. This is not a transient issue resolvable next week. This is a structural predicament that has been intensifying for 5 years, and it is now accelerating. Now, let me share my perspective on subsequent developments. I believe we are entering a new epoch within this bull market, a phase where paper and physical prices completely diverge. The paper price may remain volatile. It may crash again. It may spike. It will likely continue to be manipulated for as long as the paper market persists. However, physical silver will become progressively scarcer. Premiums will increase. Availability will diminish. Ultimately, you will simply be unable to purchase physical silver at the quoted paper price. This process is already underway. Physical premiums in certain regions have exploded. Japan observes 60% premiums. Dubai observes 40% premiums. The paper price states $95. But acquiring actual metal may cost $120, $130, or more. This divergence will only expand. I wish to provide historical context, because current events have precedent. In 1979 and 1980, during the previous historic silver squeeze, analogous dynamics unfolded. Paper and physical markets disconnected. Dealers exhausted inventory. Premiums exploded. Individuals could not locate silver to purchase, even as the price fluctuated. The paper market stated one price. The physical market stated something entirely different. Eventually, the paper price was compelled to converge with physical reality. It had no alternative. When no physical metal exists to deliver against paper contracts, the paper price becomes irrelevant. Silver escalated from $6 to $50 in months, an 800% increase, among the most dramatic commodity surges in history. I am not asserting an identical scenario will replicate. Markets have evolved. Participants have changed. Regulations like circuit breakers and position limits exist now that were absent then. But the fundamental dynamic remains constant. When physical supply cannot satisfy physical demand, price must ultimately adjust upward. The paper market can manipulate prices temporarily. It can suppress them. It can engineer artificial crashes like this week's. But it cannot manufacture physical silver. It cannot mine it. It cannot create it from nothing. Paper manipulation can postpone the price adjustment. It cannot prevent it indefinitely. Eventually, physical reality prevails. It always does. The pertinent question is not if, but when. Based on my observations of mints shutting down, vaults draining, and lease rates exploding, I believe we are approaching that moment closely. Presently, 3 categories of individuals are watching this video. The first category is frightened. They witness the crash and panic. They desire to sell, to exit. They do not comprehend the underlying mechanics, and fear dictates reactive decisions. The second category is perplexed. They perceive conflicting signals, price crashing, yet mints closing. They are uncertain what to believe. They are immobilized by indecision. The third category comprehends. They perceive the paper crash for its true nature, a manipulation. They perceive the physical shortage for its true nature, a fundamental reality. They recognize this as an opportunity, not a crisis. They are utilizing this moment to accumulate while others surrender. Which category describes you? Let me conclude with this final synthesis. The paper price of silver collapsed 22% this week. During that identical week, the Perth Mint suspended sales. The U.S. Mint suspended sales. The Royal Mint exhausted its stock. Indian dealers defaulted on deliveries. China drained 27 tons from its exchange vaults in a single day. Lease rates reached 39%. The price declined. The physical metal disappeared. One of these narratives is a fabrication, and it is not the empty vaults. This is the manifestation of manipulation. This is the appearance of a disconnect between paper and physical markets. This is the inevitable result when a system constructed upon paper confronts the immovable object of physical reality. They dumped silver. The entire world is running out, and you possess the agency to choose on which side of that equation you wish to be positioned. I will continue to provide updates as this situation evolves. Subscribe if you have not already. Activate the notification bell to ensure you receive subsequent content. Please contribute a comment stating whether you believe the paper market or physical reality will ultimately prevail in this conflict. I review every comment. If sufficient interest exists, I will produce a dedicated video on that topic. Recall my initial statement, the price is crashing. But you cannot buy the product. That is not a legitimate market. That is an illusion. And now you understand the mechanics of that illusion. This is the obscured economy, because the authentic narrative is never visible on the surface. I will see you in the next presentation.